studying your last two. I swim med tea when they turned in. The staring out to mute. And can lend a pole that sunky died.
Many owner-managers and family businesses are tempted to ask for no tax or CPP deductions from their pay. At first glance, it looks very attractive. On the left side of this slide, you can see the immediate cash benefit. The paycheck is larger. $10,000 goes into the owner's pocket instead of a smaller net pay. There is more cash available today. Liquidity improves. It feels good in the short term. But the middle of this slide reminds us that every decision comes with a choice. You can choose more cash today, or you can think about the future obligations that come with that choice. Look at the right side of the slide. The hidden consequences may not show up today, but they can appear later. When no tax is deducted, it doesn't mean there is no tax. It simply means the tax is being delayed until the end of the year, when the return is filed. This can result in a significant tax bill. If the tax owing is large, the CRA may require installment payments for the following year. That creates ongoing monthly obligations, which can add pressure to cash flow. There are also CPP implications. Lower CPP deductions today mean lower CPP contributions. This can affect future retirement benefits and contribution history. In addition, elimination of deductions can also attract compliance concerns. CRA expects proper payroll practices, and consistent requests for no deductions can increase scrutiny. The key message at the bottom of this slide is critical. Eliminating deductions does not eliminate tax obligations. The responsibility still exists. Good payroll planning is not about avoiding deductions. It is about managing tax obligations responsibly while keeping the business and the owner financially healthy. A larger paycheck today may feel beneficial, but experienced practitioners always encourage clients to consider both the immediate benefit and the long-term consequences before making payroll deduction decisions. The best payroll strategies balance current cash flow needs with future tax obligations, helping avoid surprises while maintaining compliance and financial stability. Many clients focus on the immediate benefit of reducing payroll deductions, but experienced tax preparers understand that insufficient deductions can create a variety of problems later. This slide highlights some of the most common consequences that can occur when tax or CPP deductions are set too low. At the center of the slide, we see a business owner opening a notice and discovering a large tax balance owing. This is often the first consequence people encounter. When tax is not withheld throughout the year, the tax liability does not disappear. Instead, it accumulates in the background until the tax return is filed. The result can be a significant balance owing that comes as an unpleasant surprise. For many individuals, the amount can be much larger than expected because they have already spent the cash that was retained during the year. The second consequence is installment requirements. If the balance owing becomes large enough, CRA may require the taxpayer to begin making installment payments in future years. Instead of one annual payment, tax obligations become recurring payments throughout the year. Many clients are surprised when a single year of low deductions creates ongoing installment requirements going forward. The third risk involves cash flow problems. When taxes are deferred instead of paid gradually through payroll deductions, the eventual payment may place significant pressure on personal or business cash flow. Finding a large lump sum payment at tax time is often much more difficult than paying smaller amounts throughout the year through regular payroll deductions. Another consequence is increased CRA attention. Although low deductions are not automatically a problem, unusual payroll arrangements can sometimes attract additional scrutiny. CRA expects payroll systems to operate properly, and significant differences between compensation and deductions may raise questions that require explanation. The fifth concern relates to CPP contributions. Lower CPP deductions generally mean lower CPP contributions. While some individuals focus on reducing deductions today, they may overlook the long-term impact on their CPP contribution history and future retirement benefits. This may not seem important today, but it can become more significant over time. The final consequence shown on the slide is client dissatisfaction. This is an issue that practitioners encounter frequently. A client may enjoy larger paychecks throughout the year, but when a large tax bill arrives at filing time, the experience is often very different. The client may feel surprised, frustrated, or unprepared for the amount owing. In many cases, the tax was entirely predictable, but the financial impact was not fully appreciated when the decision was made. That is why the warning at the bottom of the slide is so important. Today's savings can become tomorrow's tax problem. The short-term benefit of larger net pay can easily be outweighed by future tax obligations, cash flow challenges, and unexpected surprises. The role of a professional tax preparer is not simply to maximize today's cash flow. It is to help clients understand the full consequences of their decisions. Good payroll planning considers both present and future obligations. It balances current cash needs with future tax responsibilities, and it helps ensure that there are no unpleasant surprises when tax season arrives. That balanced approach is what transforms payroll administration from simple processing into professional tax planning. This slide compares two very different approaches to payroll planning. On the left side, we see the risky approach. On the right side, we see the professional approach. At first glance, the risky approach can appear attractive because it focuses on maximizing cash today. The owner receives a larger paycheck. Tax deductions are minimized. CPP contributions may be reduced, and more money remains available immediately. However, this approach often focuses only on the present while ignoring the future. The individual sees a larger net pay, but may not think about the tax liability that is accumulating in the background. There may be no withholding strategy, no estimate of the eventual tax bill, and no plan for how that future obligation will be paid. As a result, tax season can bring unpleasant surprises. A large balance owing arrives unexpectedly. Cash flow pressures increase, and the taxpayer is forced to deal with problems that could have been anticipated months earlier. This is why the slide describes it as short-term thinking. The focus is on immediate benefits without fully considering long-term consequences. Now let's look at the professional approach. Notice that the objective is not simply to maximize today's paycheck. Instead, the goal is to create a balanced plan that manages both current cash flow and future tax obligations. A professional tax preparer begins by estimating the individual's annual tax liability. Rather than guessing, they calculate what the likely tax obligation will be based on projected income. Next, withholding levels are reviewed. The objective is not necessarily to maximize deductions or minimize deductions. The objective is to determine a reasonable level of withholding that aligns with the overall tax plan. The professional also considers CPP implications. CPP contributions affect more than current cash flow. They can influence future benefits and long-term planning decisions. Cash flow is reviewed as well. The question is not simply how much money can be retained today. The question is whether future tax obligations can be managed comfortably without creating financial stress. Most importantly, the professional approach seeks to avoid surprises. Clients generally prefer predictable outcomes, a manageable tax balance, a planned payment strategy, and clear expectations are usually far more valuable than an unexpected tax bill. Notice the transition shown in the center of the slide. The shift is from short-term thinking to long-term planning. That transition is one of the most important changes a tax preparer can help a client make. The comparison banner at the bottom summarizes the difference perfectly. The risky approach focuses on maximum cash today. The professional approach focuses on balanced cash flow and tax planning. Neither tax deductions nor payroll withholding should be viewed in isolation. They are part of a larger financial strategy. The key lesson from this slide is that good payroll planning considers both current cash flow and future tax obligations. Professional payroll planning is not about avoiding tax. It is about anticipating tax. It is about creating a plan. And it is about helping clients make informed decisions that support both their short-term needs and their long-term financial health. That is what transforms payroll administration into professional tax advisory work.